So let's talk about Crocs and its valuation. Well, first of all, what is Crocs? Well, most of you probably know it as this company that makes the plastic shoes and sandals and stuff like that. But quite recently, Crocs made a really big acquisition for the size of the company, of course. They bought a company called Hey Dude, and they're also making shoes, quite different ones. And this acquisition made a lot of change in the way that people look at the stock of Crocs. Why is that? Well, because they had to make some changes to the company in a way that it's going to be run in the near future, and they had to take a lot of debt to actually buy this company. But let's see, is the change in Crocs a good thing for their future or not? And is the fact that the price of the stock is going substantially down in the recent months, is it a trap for us as value investors, or is it an opportunity? Well, let's find out. So first of all, let's see who is actually buying the stock right now. So insider buys, that's a check. And in the last 6 months, there have been really a number of people that work at the high level at the Crocs company that are buying the stock. So we can see a number of directors, an executive vice president, and a CFO that are all putting their own private money into this company. So what it means is that people that actually work at the company believe that this is the right time to buy the stock, that the future of the company is bright, and that they will, in the long run, get a lot of value out of that. What about super investors? Well, that's an X. So right now there are no super investors that are invested in Crocs. There can be two reasons for that. One is that this is quite a small company. So for big investors, it wouldn't really move the needle in their portfolio. So they may not be interested in this stock because of this reason. But there is also another one, the one that we talked at the beginning about, the debt that this company has because of the acquisition of Hey Dude brand. Okay, so let's move on to find out how healthy this company really is. So what is the return on invested capital at Crocs? Well, that's an X, because this is 9.2%, and what I'm looking for is a company that has at least 10% return on invested capital. It's not far off, 9.2, it's pretty good, but it's not exceptional. Then let's go to free cash flow growth. So what do we think about that? That's a check, because it's 16.9%, which is a really nice free cash flow growth. Not anything incredible, but a really nice and stable growth for the last 4 years. Before that, the company had its swings, but for the last around 4 or 5 years, it's really doing quite nicely. Then share buybacks, and it's a massive check, because actually in the last 10 years, they bought almost 30% of their shares back, which is absolutely incredible, because if you invested in this company 10 years ago and you didn't buy any extra shares, they are actually worth 30% more just because of the fact that there are fewer shares at the market, you have a bigger percentage of this company without putting any extra money into it. So this is absolutely great. The next thing is the dividend yield. Well, that's an X. They pay no dividends. And we have to mention two things right now about share buybacks and about dividends. Crocs said they will not buy back any more shares or issue dividends until they pay the debt for the Hey Dude acquisition. And that's actually a really good thing and a very smart thing, because that means that the management is thinking in the long run. They're thinking about the future of the company. And to make it a strong company, they have to really get the debt down. Let's see how many years it will take them to pay the debt. And that's also an X, because it will take them right now 1.5 years to pay the debt, which is actually, it should be a check, because that's not that long, and it means they have a really strong economic situation that they can pay the debt quite quickly. But those data do not include the new massive debt that they took for Hey Dude. So this number will be at least twice as big when we will include the debt that they had for Hey Dude acquisition. So as you can see, this is not such a straightforward situation. Return on invested capital, it's okay. Free cash flow growth, really nice. Share buybacks, fantastic, but they're gonna stop it. Dividends, there are no dividends, and there will not be any dividends in the near future. And the debt, it's gonna be a problem. So if you believe that they can pay the debt, everything is fine. If they will stumble on some serious problems with it, it may be risky. So let's look at the PE, because the current PE is just 4.5, which is absolutely great. And we have to compare it to something. So let's say we compare it to a 5-year average PE of Crocs. So in the last 5 years, the average PE, and that's a check, was 38.6. So you can see that the average PE is huge compared to the current valuation. And that is because the stock really took a big hit recently. I mean, it's really, really down. So at the first glance, it seems pretty cheap. But let's do something else. Let's take revenue growth at the dividend yield and then divide it by the PE ratio. If we get a number that's higher than 1, that means that the growth of the company seems strong enough or stronger than the valuation. So let's see, the revenue growth is 8.7%. The dividend yield is 0. So we have growth of 8.7 divided by a P 4.5. So it's a check, it's 1.9. It's almost 2, almost double that. So that's really strong. That gives us an information that this company is growing faster than it is valued at right now. Okay, so let's make a valuation of this company. We have to estimate the growth rate for the next 5 years and then another 5 years. And we will make 3 assumptions, a low one, a medium, and a high one. So for the first 5 years in the low version, let's say it's 7%, and then it will go down to 5%. This is much lower than you could expect if you look at the last years of the company and the way it is growing, and especially if you think, if you consider that they acquired Hey Dude. So this low assumption is really a bad one. It means that they will not only not grow the Hey Dude brand, but that actually Crocs will slow down significantly from the present moment. Now the medium, we should have for the first 5 years 10%, 6 and 10, let's say 11%. Fairly stable, going up, so with the thought that the Hey Dude is going to work okay or pretty nicely. And then the high one, 13%, and from year 6 till 10, 18%. In this scenario, we believe that the whole acquisition is going to go really well. They're going to pay the debt and then really expand the Hey Dude brand, which is right now mainly in the US, and that Crocs, through its experience and contacts, can make it a global brand. So, what's the value? Well, if we take all the data in, the intrinsic value is somewhere between 125 to 250. But of course, we always have to have a margin of safety. And I use 30% margin of safety. And that would mean that I would consider buying the shares if they're from $87, that's the low estimate, till 177, that's the high version of our estimates. And right now, the stock is selling for 51.10. So as you can see, it's all green and it really seems like a cheap stock. So now we have to consider, is it a buy? Because yes, it seems really cheap, but there is a risk of the debt. If the company has a really big debt, then this can bring the company down. So there are some unknowns, and it may be a risky buy, but at that price, having two really good brands at that price, well, for me, it's a buy. And I'm buying the stock right now. Probably it will go down even more. I can buy even more with a better price. That's absolutely fine. But that's my opinion, and I see the risk. So if you're interested in this stock, check it out for yourself. Do all the due diligence. Try to find more information about the company, where it's heading, and so on. Let me know what you think. Do you think that my assumptions of the growth are ridiculous, maybe too high or too low? And what do you think the future of Crocs is? So thank you a lot, and see you in the next one. Bye bye.